Now, please welcome your hosts for today's Taxes in Retirement webinar, Joe Anderson, CFP, and Big Al Clopine, CPA. Hello, good to see you today.
Oh, I see Joe too.
There he is. Joe, how are you?
I'm great. I think the gang's all here.
We are.
Yeah, very exciting stuff. The news is coming out fast and things are changing rapidly. So we're already in mid-November. And if you take a look over the last couple of weeks in regards to tax law changes and some revisions to the BBBA, you watch this in a month and it might be all worthless. So what we're going to try to do today is just kind of give you the breakdown of what's going on, some news that you could probably use. But more importantly, Al and I want to just spend some time with you to answer any questions that you have in regards to taxes, your retirement. I guess the agenda is wide open, if you will, for your questions. We have a lot of fun doing this. Al and I have been doing this presentation or something like this presentation for maybe the last almost 15 years. We would used to do it at the Sheraton in San Diego, and we would have several hundred people join us, and we would do that each year. Then we would do a private event just for our clients in regards to taxes. And now in this digital age, I think we have well over 400 people and maybe expecting a lot more than that today. So we will try our best to answer all of your questions. We have a shorthand type of presentations that we'll go through. But I think more importantly, I think it's a lot more fun for us just to kind of keep it live, interactive. It gives you some value that you showed up. So Al, do you want anything else to add on that nice intro? Because Andy did a wonderful job. She's a little rusty, it sounded like. Maybe this is the new.
There's a lot of changes. A lot of things have changed today, and it all happened in the last 15 minutes before we started. So yeah, I'm a little rusty today.
Well, that's how we keep you up in tip-top shape, Andy.
That's how you make sure that the intro goes really badly. But anyway.
No, I think that's exactly
right.
That's right.
Yeah, Joe, I would say, yeah, you summed it up well. I think we're going to get into some of the new proposals, and I will say that as far as the proposals, they are changing daily. So everything we say today might be different tomorrow, but we're going to at least tell you what's in there currently.
Yeah, a lot of people do planning in regards to proposals. Please don't do that. But it's so hard to do the appropriate planning. I know a lot of small businesses, they were thinking, hey, this capital gains rate might go to ordinary income, so let's sell. A lot of our clients did that. And all of a sudden, like at the last minute, there's a little change in the game here. Every time we've seen tax legislation of this magnitude, it usually doesn't get signed until the very end of December. And I think they do that on purpose. Al, maybe refresh me. Didn't one bill get signed actually in January that got retroactive?
I forget which one, Joe, but yes, there was one that was signed in, I want to say January 4th or 5th. And it had things that you had to do before December 31st to make it happen. And so what they actually did was they said, okay, you can actually do this stuff in January and we'll count it as December. That's how kind of behind they were.
Yeah. And so I guess nothing's really changed. So kind of diving in here, taking a look, I want to start with a poll. For those of you that joined us before, we always like to kind of start things out with a little bit of a poll. But this is the tax code. This is marginal tax rates, basically going back to the history of the tax code. It started out at 7% at 1913. And then all of a sudden jumped to about 80%. How about that for a tax increase? It was around 70 some odd percent. It dropped down to about 20%. And then it was 94% for quite some time over the 40s. Then it dropped down to 70% in the 80s. And then now today we're at 35%. In 2018, we're at 37. We're due to go back to this 37% next year. But if you look at kind of a bar graph of the tax environment that we've lived in over the last so many decades, I were to ask you, where do you think tax rates are going to go, right? If you believe that, is this line going to go up, or do you think this line will go down? Let's kind of take a poll. No right or wrong answer, just kind of want to see where everyone's, I guess, attitude is in regards to taxes.
So that poll is on screen right now. If you don't see it, look at that little tab that's got the 3 dots on it, and you can use that to open the poll. And your options are, what do you think is going to happen to taxes in future? Are they going to go up, go down, stay the same, or uncertain? And I will close this poll up in 5, for, actually, I'm just going to go ahead and close it now. We're 95% of people believe taxes are going up.
Okay. We don't have the answer. Who knows what will happen over the next couple of weeks, but the trend is that tax rates are going up across the board. So what does that really mean? First off, what does that mean to you, right? We see a lot of people that they say, man, I'm paying a lot of taxes. And then when we break down their tax return, they're not necessarily paying as much as they thought. So I want Al to kind of give us some tax basics. Just go to the ABCs. So when we get more complex in some of the strategies that we want to get into, then you can kind of follow along with your own tax return. We'll also talk about potential changes. I can't stress this enough. I mean, if you look at October 28th to November 5th, a lot of changes just happened in that week. So who knows what's going to happen, but these are potential changes. Some of them you can at least kind of extrapolate where we think things are going to go. And some of you might be creating a tax time bomb. There's a phenomenal strategy that we've been talking about for years and years and years that is on the chopping block that might be no longer a strategy. So some of you might want to take advantage of that. And then we can also give you some tax planning tips. But we'll go through 1 and 2 first. We'll jam those out. We'll pause. We'll start asking you for some feedback and some questions. And we could take this webinar any direction that you want. We will get a hard out, though, in 45 minutes. This is a lunch and learn. So we'll just kind of keep cruising as we go. So tax basics. Al, let's kind of step in here and talk about just kind of the basics. When people look at their tax return, what are some lines that they should be looking at? What are some like buzzwords that you might hear all the time? Taxable income versus adjusted gross income versus what your true tax is, effective rate, and all that stuff in between.
Yeah, Joe. So let's start with gross income, and then there's adjusted gross income, adjustments to income. So I guess the way that you think about this is gross income is all your different sources of income. It could be salary, interest, dividends, capital gains. It could be pension, rental income, things of that sort. That makes up your gross income. That's kind of the first part of your tax return. The next part is adjustments to gross income, and that would be like self-employed pension plans, self-employed health insurance, alimony, things like that. So you get a deduction against gross income, and therefore you end up with adjusted gross income. And that's what's typically on the front of your tax return. After that, you get what's called an itemized deduction or standard deduction. And so the way that works is for married couples, standard deduction is a little over $25,000. Single, it's half of that. And if you itemize your deductions and they are greater than the standard deduction, you get to take those. Otherwise, you just use the standard deduction. And in terms of itemized deductions, it's taxes. But we know that with the latest Tax Cut and Jobs Act in 2017, effective for 18, that we're limited to $10,000 in taxes. So that's not as good as it used to be. There's some changes, but potential changes coming up. Your mortgage interest, but only to the extent of you have $750,000 loan or less. In some cases, some of you are grandfathered in for $1 million loan. Charity, and then a little bit of medical. The miscellaneous itemized deductions are gone. But at any rate, you calculate what your itemized deductions. You get to take the greater of the two. You subtract the greater of the two, itemized deduction, standard deduction, from adjusted gross income. And then you end up with taxable income, and that's what you're taxed on. In terms of the way taxation works, there's different brackets. It starts at 10%, it goes to 37%. And depending upon where your income falls, you'll tax whatever bracket you're in. But a lot of people get this mixed up. Once you reach a higher bracket, it's only that little extra income is taxed in that bracket. You still get the 10% bracket, the 12% bracket, the 22% bracket, and so on. It's not that once you get to another tax bracket, your whole tax changes. So that's how it is currently. There's tax credits in some cases. We like credits better than deductions because a credit reduces your taxes dollar for dollar, where a deduction just reduces your taxable income. So, Joe, I think that's kind of how I want to start on the basics.
Yeah, let's bring Andy back real quick. Andy, do you have the presentation that you're going to be able to kind of put up as well, or
I do.
No?
I do have it. Which slide do you want? Let's see. If you
Well, usually we just kind of go with the flow there, but it's all good. Just
Yeah.
kind of moving forward. We can kind of go back and forth. Alan, you looked great though.
And it's all up here, Joe.
Got
So
it.
go to a few slides, Andy, which is tax proposals.
tax proposals. Let's see.
Keep going. Or that's it.
There we go.
Potential changes. So let's kind of go through that. So these are federal tax proposals, and the first thing to realize is there are proposed changes to the ordinary income taxes and other taxes. And so let's first take a look at what we have right now. So move a slide. All right. So our current rates start at 10%, 12%, as I mentioned. They go as high as 37%. We do know that these rates are temporary. They're in 2026, the old rates pre-2018 come back. We start at 10 to 15 to 25. We get up to 39.6. So this is what's in the books right now in terms of what's going to happen in 2026. There was a lot of talk of changing the highest rate to 39.6 in different proposals. Actually, that's no longer the proposal. It would keep it this 37% bracket. But since there's so much talk about raising the tax rates, I would expect that this may happen before 2026. So you can move the next slide. IRA changes.
Let's stop there real quick, Alan.
Okay.
Is that here's something that's key that people need to really consider here. Here, we've had the 10, 12, 22, 24, 32, 35, and 37% tax rates. These are the current rates today. Okay. And they're probably the lowest that they've been in the history of the tax code. Right. And so when you look, okay, in the 2026 proposal today, this is law today, right? Despite any type of proposal or changes that may or may not occur, this is where we're sitting today. 10 stays at 10. 12 will jump back to 15. 22 will jump to 25. 24 goes to 28. AMT comes back into play. 32 jumps to 33, 35, and so on, right? So when you're looking at tax rates, you have to figure out where you fall. What tax bracket are you in to determine what type of tax planning is appropriate? So if I'm in lower brackets, 10%, 12%, maybe even the 22% tax bracket, you might be thinking about, all right, do I want to look for deductions or should I look at accelerating income because I'm knowing that these rates might go up on me? If I'm in these higher brackets, that's when you want to start looking for deductions. I think CPAs, and no offense to Alan, they're always looking in the rearview mirror trying to find deductions. But if you're in a low tax environment today, deductions are great, but you might be saving up pennies on the dollar here when you might be looking at accelerating income and pay tax at these lower rates so that future rates, when they go up, you will be taxed potentially on a tax-free range. This is where these IRA changes come into play. A lot of different news coming out, especially with the Roth IRA. Al, why don't you kind of jump in here?
All right, so let's talk about those potential IRA changes because they are changing daily. So we had a set of potential changes in April, which became completely different in September, October, and now it seems like every few days they're changing it. So Andy, go back a slide, actually. Perfect. So I'm going to stay on this for a moment. I'm going to tell you what's in the proposal as of today. This is not law. This is a proposal, which will probably change between now and acceptance. But just so you know what's in there currently, the first thing is the backdoor Roth, which is putting money into your IRA, not getting a tax deduction, but immediately converting it. That would be only good through this year. So starting next year, you would not be able to do that under the current proposal. And in addition to that, what we call the mega backdoor Roth, or in other words, when you have money in a 401k, you contribute money to a 401k that's after tax. Some of you can do that. Currently, you're able to take that after-tax money and convert that directly into your Roth IRA. That would go away in 2022 as well. So backdoor Roth, mega backdoor Roth might be gone next year.
Right. So, I mean, I guess here's the takeaway. Sorry to interrupt you, Al, but looking at this is that they're trying to get rid of after-tax contributions altogether. So if you have after-tax money in a 401k plan, if you have after-tax money in any type of retirement account, in your IRAs, you have old IRAs, look at your 8606 forms. If you have basis in an IRA, you want to make sure that you convert that by the end of the year, okay? They're looking to get rid of it. What they're saying is that, these highly compensated individuals and the rich are taking advantage of, these retirement plans. So it was one guy, the PayPal, right? He's got like $1 billion in a Roth IRA. And so they're all up in arms because he put shares of his own company inside his Roth IRA. And it was like $2,000 in the thing, right? You guys heard of PayPal, right? So PayPal blows up and his shares are now worth $1 billion and it was inside his Roth. Pretty good planning by the gentleman. But now they're saying, wow, this is crazy. Look at this person. They can't do that. So what they're doing is kind of blowing everything for all of us. So if you make a little bit more income, they're going to say, all right, no more after-tax contributions, and you can't convert that to a Roth. If you have a 401k plan that offers after-tax, no more, right? And then once you do have the after-tax, they're also saying you can't convert it. So what we're looking at now is that, and then they want to get rid of the Roth conversion altogether in 10 years, okay? So we have time to really take a look strategically to make sure that you're doing things appropriately, but they're saying now, wow, the Roth is really working well. It's a great planning tool. You know what? It's so good. Let's get rid of it, okay? So that's probably what's coming down the pike, in my humble opinion. I don't know, but you look at the writing on the wall. They got rid of the stretch IRA that allowed beneficiaries to distribute their tax over their lifetime. Things are changing. You want to make sure that you act now. So
yeah, that's a good point, Joe, because right now under the proposal, we talked about Backdoor Roth and Mega Backdoor Roth changing. But the Roth conversion, the current proposal is that goes away at the end of 2028. So by 2029, you would not be able to do any more Roth conversions. Again, these dates are jumping around. It was at the end of 2031 at one point. Now it's 2028. Who knows what we'll actually end up with? But I think it's really important to consider strategies to get as much money into the Roth IRA currently as you can. There's also one more quick thing on the Roth and the regular IRA. Once you're at $10 million, and this is where the founder of PayPal comes in, then you're supposed to have a required minimum distribution, regardless of your age, for 50% of the amount that's over $10 million. So that would be, and actually it was $5 billion this gentleman has in his Roth. So we'll have to see what happens there. Then the next thing I want to talk about is the state and local income tax. So that'd be the next slide, Andy. So right now it's currently $10,000 is the maximum amount that you can deduct for state and local taxes. And the proposal is to make it $80,000, and that would be, that would be through 2031. So that would be 10 years. Now, as early as, or as recent as 6 days ago, that was 72,500. And this is a recent thing that's in the proposal, so I don't even know if this will stick or not, and it's moving around, but this would be very helpful if we get this one. And this could potentially be retroactive for 2021. Next slide.
Well, especially people living here in California. I know we have people kind of all over the country tuning in today, but California, we pay a lot of state taxes. And so a lot of you lost a big deduction when they capped it at $10,000. So something good that's coming out of this is that the proposed is, for those of you that pay a lot of state taxes, then now we're looking at $80,000. So this could potentially give you, some pretty good tax relief. So hooray for that. But then now here comes more negative, the net investment income tax, right? So the 3.8% surtax that's on capital assets. This is going to roar its head on all type of income, Al.
Yeah, exactly. So currently it's only passive income, which is interest, dividends, capital gains, rental income, and the like. or business income if you're not actively involved in it. But now they're saying, no, we want it to include passive or active income as well. So this would be if your income is over 400,000 for single, 500,000 married, and you would have to pay that 3.8% tax on that kind of income as well. Although it's based upon modified adjusted gross income, which doesn't include salary, and Schedule C business income subject to self-employment tax. So again, this is all over the place. So we don't know what's going to happen, but this is what's in the current proposal. Andy, next slide. There would be a new surtax on high income taxpayers. And this is for taxpayers that have income over $10 million and $25 million. So it's not going to affect most of us. However, I bring this up because for quite some time, there was a proposal to change the taxes on capital gains. Once you got over $1 million, it would be taxed at ordinary income rates. And then there's also discussion about changing the tax rate, the highest rate from 37 to 39.6. Both of those are gone, but this is what's in its place. So the 5% extra surtax would be on all types of income over $10 million, regular income, ordinary income, and capital gains, any type. And then if you're fortunate enough to have income over 25 million, you get another 3%. So this is an 8% additional tax, potentially for some people, over and above the current tax rate. And one more slide, Andy, and I'll kind of wrap it up on corporations. So there's a discussion here that some corporations are loading up on tax deductions and not paying their fair share of tax. So what this change would be that there would be a 15% minimum tax on what we call book income, which is the income that is reported to stockholders and shareholders, which is generally different than the tax return. So that would be a minimum tax. And then there's also going to be an extra 15% tax, minimum tax on foreign income, foreign entities, foreign sales, that type of thing. So anyway, let me reemphasize, these are proposals. In fact, they're changing daily. So we don't know exactly what's going to happen, but this is what's in the proposal as it stands as of today.
Let's pause there. Let's go to all of you. We kind of threw a bunch at you there. Let's see if there's any questions that came in.
We have a bunch of questions. All right, let's start at the top. Michael said, as concerning RMDs, is the Secure Act 2.0 any closer to being passed in Congress? If so, I believe RMDs age increases once again. Is that correct?
Yeah, Secure Act 2.0 would increase the RMD age from 72 to 75. It does increase the amount of money that you have to pull out, but it gives you some relief. From 70 and a half it was, they moved it to 72, a big year and a half. And then now they're looking to push it to 75. So yeah, it's on the docket. So we'll see if it gets any closer to signing. I would imagine, there's some things in that. The Secure Act and the Secure Act 2.0, to be honest with you, in my opinion, wasn't anything huge. The thing that really blew up was the stretch IRA in that. But any other proposals for that, or to make I forget the other bill that passed. What is Secure Act? Like securing every
setting every community up for retirement enhancement.
Yes,
yeah, exactly.
Didn't really secure
I don't know why I still remember that.
I a lot of people that save money in retirement accounts.
I would add no one's talking about Secure 2.0 right now, so it's not in the forefront. Everyone's talking about the current proposals that I just went over.
Okay, we have two questions regarding AMT. Michael said, is alternative tax back? And Mark says, how do they figure AMT?
Okay, let me take that. Alternative minimum tax never went away. It's still there. But the main reason folks were subject to alternative minimum tax is because of state and local income taxes, because that's not a deduction for alternative minimum tax purposes. So when you have high state tax, like we do in California or say New York or certain other states, then you've got a big tax deduction that's not allowable for alternative minimum taxes. And therefore, you got to calculate your taxes both ways. Whichever is higher is the tax you pay. And so it's still there. It just doesn't apply to most people. If they do change the state and local income tax to $80,000, more people will all of a sudden become subject to AMT again. And how it's calculated, it's the same income as you have regular tax with a couple additions like incentive stock options and things like that. And then there's certain things that are not deductible, which the main one is state and local taxes.
All right, so the next question comes from Georgia. If these tax changes pass next month before the end of 2021, would they apply this year or would they start next year?
Yeah, almost all of them would be next year. Some would be 2029, some would be 2031. But the only one that I've heard that could be retroactive is the state and local income tax to $80,000, retroactive to January 1st of 2021.
Marna says, are there any concerns with politicians ending up taxing Roth withdrawals?
It's a great question. There actually was some discussion for those that had gigantic Roths to try to tax some of the earnings, some of the growth. And that was even in one of the proposals that was taken out. When you think about
gigantic Roth, explain that. Like a 10 billion or like $1 billion Roth or
exactly.
$100 million Roth. Right.
It would just be those, but that was taken out and rightfully so, because the promise has always been you get the money in the Roth IRA, it's tax free. So that was I honestly think that would have been taken out anyway before it passed, because it's just not fair.
Here's my thought on it, and I'm not a politician. I don't know, but if you look at, there's two things that they could do, right? They could either tax or get rid of it. And it looks like the trend over the next 10 years is potentially phasing people out of it, not necessarily reverting it to tax. So what I'm looking at doing is trying to get as much money as I possibly can in a Roth IRA, because I love the fact of compound tax-free growth, and I feel that tax rates are fairly low. Is that a gamble for me to do that? Sure, I guess anything's a gamble, but I'm following the law to the T and making sure that I'm doing everything appropriately. 100% of the time in the tax code, it's been grandfathered in. So maybe someone else has another account. They're going to be taxable. I put mine in at the certain time. I believe wholeheartedly that all of my income is going to be tax-free.
All right. Our next question comes from Terry. Do the 3.8% net investment income taxes apply to Roth conversions?
They do not. So currently the 3.8% starts on your passive income when your income is above 200,000 single, 250,000 married. So passive income being defined as interest, dividends, capital gains, rental property type income, business income that you're not actively involved in. Other types of income, salary, pensions, IRA, Roth conversions are not part of this calculation.
We've had a few people ask for you to repeat the proposals that affect the Roth. Georgina says, what pieces of the Roth IRA 401k backdoor conversions are proposed to be banned starting in 2022? I'm a bit unclear what is getting phased out over time, 2028, 2029, versus immediate stop in 2022.
Sure.
All right. Let me take that out. So there's something that's called the backdoor Roth IRA. And so what the backdoor is that if I'm not eligible to make a Roth IRA contribution because there's AGI limits. So let's say if you're single, if you make more than, call it 130,000, if you're married, a couple 100,000, you're disqualified to do a direct IRA or Roth IRA contribution. So the workaround was that, you know what, I am over the AGI limits, so I'm going to make an after-tax contribution to an IRA. And then take that after tax because I've already paid tax on it, and I'm going to convert that directly into a Roth. So it was a backdoor way to get money into a Roth IRA. So I'm making an IRA contribution. I can't take the deduction because I make too much income, but I have basis in the IRA. So I would take the IRA and I would convert it directly into a Roth. Okay, so that's the backdoor. So what they're saying is that no more backdoor. So you cannot have after-tax contributions in an IRA, and you cannot convert those after-tax contributions of an IRA into a Roth IRA. Another way to do this is called the mega backdoor or Megatron or whatever you want to call it, the barn door, is that you have a 401k plan through your employer. And you could put after-tax contributions into that plan. So because, again, they're after-tax, you could take those after-tax dollars and directly convert those to the Roth. A ton of you, right, have after-tax money. We've seen hundreds of thousands of dollars of after-tax money sitting in people's 401k plans, right? And we're like, you understand you have after-tax dollars here. They're like, yeah, you know, I've been a participant of this plan for 30 years, and I've always just, you know, added more to the after-tax component. You can convert that directly into Roth, and now you have a large sum of money in a Roth IRA. It's another way to get more dollars in a Roth with limited tax, right? Because you've already paid the tax on it. A regular Roth conversion is you're taking money from a pre-tax account and you're converting it into a Roth IRA and paying the tax. An after-tax contribution or conversion, there's no tax because it's after tax. They want to get rid of both of those by the end of this year. So that's why I'm saying, if you have not made a after-tax IRA contribution and converted it to a Roth, now's the time to do it. If you have after-tax contributions in your 401k plan or another qualified plan, take a look. Now's the time to convert. If you have after-tax monies that are sitting in your IRAs for years and years and years, take a look. Does it make sense to convert? Now, it gets a little bit more complicated than that because there's pro rata and aggregation rules, and you got to follow the rules on how you do all of this. But I guess just to answer your question, that's what we were talking about initially when it comes to the Roth. Yeah. In 2029 and 2031, they want to get rid of Roth conversions altogether, depending on your adjusted gross income. This was a rule that was back, I don't know, I forget now. I think 2010 is when they changed it. You had to have modified adjusted gross income under $100,000 to do a Roth conversion. They took that out, or in 2010, they got rid of that law. So that opened up Roth conversions for a lot more people that have a little bit higher income. They want to do the same thing of limiting Roth conversions to individuals depending on their adjusted gross.
All right, moving on to the next question. Andrew says, as a medical professional, friends and mentors always commented on doing the backdoor Roth conversions. Now that that will be gone, are there any alternative options left?
Convert. It doesn't matter. This drives me crazy. Okay.
Oh boy, here we go.
Here we go. Get ready for the rant.
I'm going to start sweating. Okay. Who cares about the back door? It doesn't matter. It's the same. And Al will correct me on very small circumstances. You have a tax deferred account. It's a 401k plan. Let's say IRA, 403B, 457, TSP, things like that. You make a contribution into the plan. Okay, you got a tax deduction for it. You never pay tax on those monies. Same with a backdoor Roth. You took $6,000 from your checking account that you pay tax on, and you put it into an IRA, and then you convert it into this tax-free account. And everyone was like, yes, the backdoor, it's so cool, right? But it's the same tax, right? It's after-tax dollars. You already paid tax on the money. Then you put it into an IRA, then you converted it to a Roth. You got it into the Roth without tax, but you got it in your paycheck with tax. What happens when you put into an IRA right, and you take the tax deduction, you get the tax deduction, and then when you put it in the Roth, you pay the tax. It's same. The problem is for individuals that have maybe worked one job their whole life and everything is in their own 401k plan, and they don't have a Roth option in their 401k plan, so they can't convert out of their existing plan. So they could open up another plan, make the IRA contribution, and convert it to do like a standard Roth contribution. But if you have other dollars that is pre-tax, just convert the $6,000, $7,000, $5,000 a year. The tax is basically the same. You look at what your taxable income is, and then that's going to determine basically how much that you want to convert.
Okay.
Good enough, Al? You want to?
Yeah. No, you got it.
At all?
That is the workaround. Just do a conversion. And under the current proposal, you can do that through 2028. And even in 2029, if you're single and your income is below 400,000, married 450, you can still do Roth conversions to that level.
Okay, Raymond says, was there talk about retroactive capital gains increases to March 2021?
There was all kinds of talk about that. so the first one we had that I remember was in April when the budget came out. I think it was a date in April, that's when the capital gain rate was going to change. And then we had the House Ways and Means Committee come out with a new proposal. I believe that was in September. So they had that date in early September. And now that's gone. We don't have any of that. So we don't have to worry about it.
Yeah, what's replaced that is a surtax on individuals on all income instead of capital gains at certain thresholds. What is it, 10 million and 25?
Correct. Yep.
All right, Ying Lin says, does this also block the Roth 401k conversion to Roth IRA after 2031?
No, that would be a rollover, right? So if I have a Roth 401k and I want to move it into a Roth IRA, that's totally fine. That's a rollover. You're just saying it's like, right? There's no taxes. There's no harm, no foul. You're just moving the Roth 401k into the Roth IRA, which I would recommend everyone do that. Do not keep a Roth 401k in the 401k for multiple reasons, but here's two big ones. One, a 401k has a required minimum distribution, even if it's a Roth. If it's a Roth IRA, there is no required minimum distribution. So you're fine. You don't have to take the money out. If you keep it in the 401k, you will have to take an RMD, okay? Even though they're both Roths. Next, you have to look at how the distribution is calculated from a plan that has both pre-tax and after-tax. A lot of times what we've seen is pro rata. Right? So let's say I want to take a $10,000 distribution from my 401k plan and I want to take it all Roth or I want to take it all pre-tax. Okay? Well, it depends. Maybe I have 50% of my 401k balance pre-tax and 50% Roth. That $10,000 comes to me, half Roth, half pre-tax. If I separate them, if I move them into IRAs, now I have a lot more control on my distribution as I try to create that income.
Okay, next question is from Marna again. She says, are they going to get rid of Roth 401ks?
No.
Okay. Jay
I don't
says,
know. I mean, I'm not on Capitol Hill, Marna.
Yeah, you know already. You said no very definitively.
Well, right. You know, if they change it, I'll say yes. I mean,
tomorrow they'll probably say yes.
I hope not.
I will just say I've not heard anything about getting rid of Roth 401ks, so I don't think so. But you never know.
Yeah, who knows?
Jay says,
not currently. There's no talk about that in the future. Yeah, they might. They might say, we're done. Hopefully not.
Jay says, is there any indication that the 1981 Social Security change of taxation of Social Security benefits that was based on an income of $44,000 that was used to determine the taxation, that they will update that income level and therefore less people will have Social Security benefits taxed?
That's a really good question because they changed that like with Reagan, right? Because we were only taxed roughly 50% of our Social Security was subject to income tax, and it was based on those income thresholds. And that was the top 1% of wage earners when they put that into place. What they didn't do is they didn't put a COLA on it, right? So the top 1%ers 40 years ago, right, is now, right, with inflation and job wage increase, right, they kept that steady. They did change it back in the 80s when they added the other 35%. So now we're subject to up to 85% of our Social Security subject to income tax, right? So they did a small adjustment there, I believe. But no, we have not seen anything of them increasing the cost of living on the provisional income numbers. What provisional income is that it's half of your Social Security, and then you can add on your adjusted gross income, okay? Including tax-free income from municipal bonds. The only income really that's not included in provisional income is Roth distributions. So again, that's why we love tax diversification. So that if I have a lot of money sitting in my Roth, then I can look at the provisional income numbers and say, hey, right, I'm going to take from these two pools, and all of a sudden my Social Security is not taxed at all. But a lot of you have most of your money in the tax deferred accounts. So then you have your Social Security, half of your Social Security, plus your RMD, plus your interest, plus dividends, maybe real estate income. And it's almost impossible to get out of that 85% threshold.
Yeah, and I concur with that. There's been zero discussion of changing that. So I would say that would be unlikely at this point.
Jorgen says, how much after-tax money is needed in a 401k to make Roth conversion worth it?
If you have $1 in after-tax, convert it. Right? It's really easy to do. You can just take the after-tax and say, I want that $1, because if that $1 continues to grow, right, the growth of that $1 is going to be subject to income tax. So I'd much rather have the $1 grow in a tax-free environment. So then if it grows to $2 or $5 or $10 or whatever, all of that is tax-free. So any after-tax dollar component that you have in a 401k, or if you have an IRAs, I would look at trying to get that into a Roth for sure.
Stephen says, when you do a Roth conversion from IRA to Roth, are taxes automatically deducted as a part of the process?
No, and you don't want them to be. So if I'm taking money from this account here and I'm converting it here, so I got my IRA and I want to convert it to my Roth IRA. Let's say I owe 15% in tax. Don't withhold it unless, Al can kind of chime in here, but I would suggest never withholding, especially if you're under 59.5. If you're under 59.5, and if I do a Roth IRA conversion and I withhold the taxes from my conversion, I'm going to be subject to 10% penalty on that withholding. Okay, you can withhold. Don't get me wrong. You can say, I want to do this conversion, withhold 20% in tax. They're going to withhold it for you. All good, right? But we like to pay the tax outside with outside dollars. So you're maximize the amount of money that goes into the Roth, especially if you're under 59.5. Do not withhold, because then it's just you're throwing money away there, because it's the excess penalty of 10% to the feds, and then plus state of California, depending on where you live.
Yeah, and I agree with that. There's almost no cases where you're under 59.5 where you would want to withhold. When you're over 59.5, it's okay. It's not necessarily recommended, because we'd rather have you pay the tax with other money so you maximize what goes into the Roth. But if you don't have any other money and you're over 59.5 and it still makes sense because of your tax bracket, then you could be a candidate where you could withhold.
Okay, the next question comes from, well, actually, there's two questions that are kind of related. Peter says, I'm 70. Should I convert my 401k entirely to a Roth IRA this year or do it over 2 years? And Deborah says, I have $50K in a savings account. Can I transfer all of it to Roth IRA?
Well, the first one is no. Don't convert it all, although I don't know the amount you have. I mean, depending upon your tax brackets, if you're in a low enough tax bracket and the conversion keeps you in the same bracket, you could do it all this year. But in general, you would like to spread it out a little bit, because then you can take advantage of lower tax brackets. You can also potentially, you pay that tax later. The only downside of that is any future growth in that Roth IRA for that year. You'd have to, it would be taxed in your regular IRA, and so you'd have to pay tax on that. But I'd say in general, you kind of want to stretch that out. And in terms of $50,000 in a savings account, no, you can't put that into a Roth. But here's the rules. The rules are you can put $6,000 into a Roth per year if you have that much earned income, or your spouse has that much earned income. And it's, have I got that right, Joe? 6,007? I can't remember.
Yeah, you need earn income to make a Roth IRA contribution, right? Or one spouse, you can make a spousal contribution. So depending on if you're 50 or over 50, so it's 6,000 or 7,000 or 6,000 if you're under 50. They made some changes in the contribution limit, so they increased the AGI limitations for 2022. They made a little bit bigger window. I think it's usually they just increase it by 10 or 20,000 in regards to AGI for you to qualify, but they did not change the contribution amount. Change the contribution amount for your Roth 401k. Let's go back to the tax return again, looking at taxable income. So I'm not sure if you're single or married, but let's just assume that you're, I don't know, since I'm close to married. Here, the top of the 12% tax bracket is $80,000, right? I'm rounding here. It's 81,050. So let's say that you have a taxable income of $70,000. So you look at your tax return, it's the bottom line of your 1040, and you have taxable income, not adjusted gross income, not modified adjusted gross income, taxable income of $70,000. Well, you now have room in this 12% tax bracket of about $11,050 that you could convert, and you would pay 12% in tax. So if you converted, let's say $50,000, all right, well, now the first $11,000 of that conversion is going to be taxed at that 12% rate, but then everything else is going to be taxed at this 22% rate. So it depends on how much tax that you want to pay, right? So be careful with this whole, let's convert it all. We've seen that. And then, it blows people up down here. It's crazy. So don't do that. Look at your tax return, see what taxable income that you're in, and then look at the chart and say, okay, well, I'm at 80,000 or I'm 172 or 329, right? Depending on what bracket that I want to pay. We like these brackets quite a bit. 24%, 10, 12, 22, 24. We look at this all day long to see if it makes sense to convert. And in most cases, it probably does. 32, 35, 37. These brackets are a little iffy. So just to kind of give you an idea or comparison, that looks really good.
I was going to say, that is quite a drug.
And it's iffy because the tax rate that you're paying is so much higher. From 24 to 32% is an 8% increase. So you kind of want to stay out of that bracket if you can.
Yeah, and the 24 could go to 28. It was 28, right? 22 could go to 25. It was at 25. So that's why we always kind of take a look here. 10, 12, 22, 24. These are fairly cheap rates historically.
Okay, the next question comes from Linda. She says, I've discussed numerous times converting IRA funds to my Roth. I have one each regular and one each 401k, and was advised not to due to my tax rate, which is already high for me, in my opinion. Why would my investment counselor and CPA so advise? My MAGI is well under 100k.
Single or married? I didn't hear it.
She does not say. Linda, let us know if you're single or married.
So in her case, right, her modified adjusted gross income, you can't look at MAGI, right, for a Roth conversion. So if your MAGI or modified adjusted gross income is $100,000, you have to look at what your taxable income is. Your taxable income could be significantly lower. But if your taxable income is $100,000, and I'm not sure if you're single or married, but if you're single, right, you're in the 24% tax bracket. $100,000 is right there. So it's like, okay, well, don't do a conversion because you're in the 24% tax bracket. And maybe depending on how much money that you have in the overall account, what your other fixed income sources and so on, right? They might say 24 is too expensive. If you are married, okay, $100,000, you're in the 22% tax bracket. And so again, MAGI does not dictate this number. It's taxable income. So look at your tax return, bottom line on that 1040. That will tell you where you fall here. And if they don't want you to pay 24%, there's probably a reason, okay? But if you think you have a lot more money in your retirement account, you have to forecast this out. Where do you think you're going to fall in the future tax-wise? If it's going to be 24% or higher, convert. If it's going to be lower than 24%, if you think you're going to be in the 22, 12, or 10, then don't.
Okay, Joe, do you want to continue taking questions?
Yeah, I don't know
I think we've got hundreds of questions that I have not had a chance to get to yet. And we've been going for 50 minutes now.
Okay, yeah, well, let's, I'd much rather answer people's questions than going over some canned stuff that they're going to ask more questions on the canned stuff that we're already answering with the questions that we're doing now.
Okay, Terry says, can you put pension money that has been taxed into a Roth?
Yes and no. You could do it as a contribution if you have other earned income, but the answer is no.
Okay, Ken says, any thoughts about borrowing against high unrealized appreciated assets expected to step up upon death to avoid taxation altogether?
I assume that means borrowing on an asset instead of selling it. And
it says borrowing against high unrealized appreciated assets. Yes.
Yeah. So in other words, if money's needed, if liquidity is needed, that could be a strategy to get some money. It's a loan, so it's not currently taxable. And depending upon your age, if you're 35, maybe that's not a great strategy. If you're 85, maybe that is, because at least the current law is that when you pass away, your heirs get a step up in basis. So that would probably be a better strategy than selling. But anytime you borrow money for any purpose, including on securities, there's risk involved that you got to pay that back.
That's a really interesting thought, because you look at it to say, hey, I have money here and I don't want to pay tax on it. Because remember, your tax deferred assets, your IRAs, 401ks, 403bs, TSPs, pension plans, so on and so forth, they do not get a step up in cost basis at death. And what a step up in basis means is that, let's say you purchase an asset for $10,000 and now it's worth $100,000 and you die. And then your beneficiaries take that asset and sell it. There is no tax because their now cost basis is $100,000. So let's say that this person has money here with a $10,000 cost basis, but it's worth $1 million, right? And it's like, well, I don't want to pay that tax, so let me just take a loan, because the capital gains rate might be higher than the loan amount that I pay. So you take a loan, right? You live off the loan, then you die, then the heirs will pay off the loan and then get the asset at a stepped up basis. It's an interesting strategy, interesting way to look at it. Risky, but that would definitely avoid tax.
Another one would be to consider a charitable remainder trust, which I don't have time to go into, but you put an appreciated asset in, the trust sells it, pays no tax because it's tax exempt, and you get a lifetime earning stream. So that could be a strategy as well.
Okay, we have two questions that are very similar. Wen and David both asked this. Roth conversion increases Medicare the premium. How do people usually deal with that? Is from Wen. And David says, for people on Medicare doing Roth conversions, how should you take into account the Medicare premium?
I could take that. So where is it? Now, why don't you start while I'm looking? Here we go.
So
when not to do a conversion. Okay, feel well like I'm on Sesame Street here. Zero capital gains rate. Okay, so right now we have a zero capital gains rate. So if your adjusted gross income is in the lower two tax brackets, and if you want to sell some stock, you don't have to pay capital gains tax. There's a 20% QBI deduction for you small business owners that you can take this deduction, and it gets a little complicated, but here we're looking at IRMA. I think this is the question. So when you look at a Roth IRA conversion, that will adjust your income, right? Because you're adding income to your overall tax return. And so what do they do? Medicare will look at your tax return and say, you know what, John Smith, you just added $200,000 to your taxable income or your modified adjusted gross income, then that's going to increase the amount that you pay for Medicare premiums. So what Al and I would suggest that you do is you take a look at the adjusted effect of the IRMA, the increase in your Medicare premiums for that year, right? And you add that back into the tax, and then you divide it to see what your effective rate is. In most cases, depending on how much that you have in retirement accounts, if you have a large balance, let's say $1 million or more, it probably makes more sense to convert because you're going to get hit harder later, right? Because those RMDs are going to start shooting out, and then you're going to be stuck with a higher Medicare premium for life. If you have a lower account balance, let's call it a few $100,000, then it probably doesn't make sense to do the conversion. I kind of oversimplified that. Al, do you want to get more technical?
Well, I think that's basically what it is. I mean, the only difference is that when you have higher income, it affects your Medicare premiums 2 years from now. So you're basically taking extra payments that you're going to make 2 years from now and adding that to the additional tax you pay this year to figure out your effective rate. And just like any calculation, you look at your effective tax rate to do the conversion versus what your tax rate would be later with a less of an RMD, and to determine does it make sense? In other words, if you're in a 24% bracket now, and will be in a 24% bracket in the future, maybe it makes sense. If you're in a 12% bracket now and will be 24, it totally makes sense because that extra Medicare premium won't be that much. On the other hand, if you're in a 32% bracket today and you'll be in a 24 in retirement, maybe a conversion doesn't make sense anyway. So all these things need to be looked at. But it really depends upon the size of your IRA, 401k, because the higher balance you have, then you have a much higher required minimum distribution and much less flexibility. In some cases with high IRAs, we do still recommend conversions even when people are in higher brackets.
Okay, the next question comes from Terry. Does a Roth conversion done between January 1 and April 14th of 2022 count on the 2021 tax return or 2022?
2022. So a Roth conversion has to be done by December 31st to count for that year. A Roth contribution can be done by April 15th.
Hitesh said, I have rolled my 401k to IRA. I'm afraid to invest a lump sum converted money into the market. What should be my strategy?
Okay. You're afraid of the market to invest in the market as a lump sum. You could dollar cost average is another way to look at this. Let's say you have a $100,000 that is now sitting in cash in your Roth IRA that you converted. Instead of saying, hey, I'm going to fully invest this today, you could call it $10,000 a month. And you slowly can, invest it into whatever allocation that you feel appropriate. That's one strategy. For me, I believe that if it should be invested, it should be invested today. I forget what the studies say, but it's better theoretically, and if you look at statistics, to get it fully invested right now. But however, if you can't sleep at night and you feel uncomfortable and you're probably going to sell when the market goes a little bit bananas anyway, I would slowly leak that money into the allocation that you want over time.
Yeah, and I might add, maybe if you want to get a 60% allocation in stocks, maybe you start with a 30% and gradually increase it over time to 60. So that could be another approach.
I think what do we got? We got 5 minutes left. We got time for one more.
You got about 2 minutes left, but
okay,
go as long as you want.
One more question.
Okay, Terry says, why would you put after-tax money into a 401k instead of directly into a Roth?
Oh, good question, Terry. So let me explain, and I will get out of here after this. Tax-free, okay? So if I'm making a Roth IRA contribution, I can make a $6,000 contribution, okay, if I qualify, and then plus $1,000 if I'm over 50. So that's one way to do it. So this $6,000 or $7,000 is sitting in my Roth IRA. That $7,000 grows to $14,000, and I pull the $14,000 out, and I pay zero tax forever. Boom. Awesome. Okay? So that's one way to get money into a Roth IRA. Another way to get money into a Roth IRA is taking dollars from a tax-deferred account, a 401k, IRA, 403b, and converting it, okay? But I have to pay the tax when I convert, okay? So if I convert 10,000, 20,000, 50,000, whatever, I have to pay the tax. There are some 401k plans that allow you to do after-tax contributions, okay? So let's say I have a 401k plan that allows me to put $50,000 into the plan, $20,000 pre-tax, $30,000 after tax. And if I can afford it, so I put my $50,000 into my 401k plan this year. So the $20,000 I'm going to keep in that 401k plan because I don't want to pay tax on that, but I'm going to take the other $30,000 and I'm going to convert it into my Roth and pay zero tax. It's just another way to get more money into a tax. Like the one question, hey, I have $30,000 sitting in my checking account. Can I put that into a Roth IRA? The answer is maybe, if I had this 401k plan that allowed after-tax contributions, that I could put it here and then convert it out. So, folks, we went long, a lot of questions. This was great. I know there's a lot more. I'll go through them. We'll answer them either on our podcast or hell, I don't know, maybe we do this again and make sure that we get everything covered. We really appreciate you guys' support and hanging out with us over the many, many years. We truly appreciate it. Hopefully all of you have a wonderful holiday season coming up here. Can't believe it's almost Thanksgiving and then the holidays. So, Andy, I'll give it to you.
You cannot control the markets. You can't control legislation, but armed with the right information, you can control how much you pay in taxes. With all of these tax changes possibly becoming a reality, now is the best time to schedule a free tax reduction analysis to find out how much you could be saving. We have more people on this webinar. I think we've got about 400, 500 people that are attending today than we have ever had before. So the calendar is getting very, very full. Schedule right now to make sure that you can get in before the end of the year to have your tax reduction analysis. It's an online video meeting via Zoom. It doesn't matter where you are in the country. The normal fee is $275 an hour, but we want to help people get the most out of all of these tax law changes. So because of everything that's going on right now, your tax reduction analysis is free. We aren't going to sell you anything. Pure Financial Advisors is a fee-only fiduciary financial planning firm. We don't sell any investment products. We don't make any commissions. And the fact that we're a fiduciary means that we are required by law to act in the best interests of our clients. Get choked up there. Click the link in the chat that you see there and schedule your tax reduction analysis today. And if you're already a client of Pure Financial Advisors, if you have any questions about anything you saw in today's presentation, please contact your advisor for your tax reduction analysis. If your questions did not get answered today, that's a perfect reason to schedule a tax reduction analysis. Please join the mailing list. Please listen to the Your Money, Your Wealth podcast and watch Your Money, Your Wealth television. Thank you so much for joining us today. Have a wonderful day, everybody.